All right. Well, we are welcoming everyone and looking forward to this evening's conversation. We're going to be talking about uh, relevant information to LPs, and we're going to be talking to three seasoned LP investors who have portfolios as LPs, and we're going to hear their thoughts on, the good, the bad, and the ugly, and mistakes that they've made investing as an LP, if any. Hopefully, some to share, and some suggestions that they have as you navigate syndication as an LP. So we'll start out and welcome everyone. If you have any questions, send them in the one of the boxes. You know how to do this on Zoom better than me. I'm sure in the Q&A section you can send some questions. Happy to uh, address the questions as we have time to do so. First, really quickly, I want to introduce our three panelists. Nimesh Patel, principal at Lion Park Capital, orthopedic trauma surgeon, and he has invested. You can see him in Golden, Colorado. Say hi to him in Golden, Colorado. He has invested in 24 deals and counting, most of them as an LP, some of them strictly as an LP, some of them as a GP LP, some of them his own deals. So that's his background, that's his experience. Lionparkcap.com is his website. You can go look at that website after this conversation. Do that afterwards. Trevor McGregor, uh, I've known Trevor for more than a decade. I I don't even know how many years, by 15 years or so. Trevor is a master platinum coach. He is the coach that I use starting out and then and then some. And he is someone who I seek advice from. Um, along have sought advice from and still do seek advice from along my journey. He invests as an LP, but here's what's interesting about Trevor. I thought that we could get a lot of value from. He since he coaches LPs and GPs. And so he invests, yes, in about a dozen or so deals as an LP, but he also has his finger on the pulse of what GPs are going through, what LPs are going through currently. And obviously, he's not going to share any confidential information about any individual, but certainly the theme that he has seen across those conversations and different topics have bubbled up, and I'm looking forward to hearing his from him and from his perspective based off of that. And then we got Pascal Wagner. Really grateful to have Pascal on here as well. He built a $150,000 cash flow portfolio that includes 20 plus deals as an LP, 23 specifically as an LP. We're going to talk about that because I want to know if it's still $150,000 cash flow. And I want to learn more about that. He is the founder of Grow Your Cash Flow. By the way, Trevor, you can find his website, is his name, Trevor McGregor. And Pascal, his website is growyourcashflow.io. He's the founder of, lo and behold, Grow Your Cash Flow, and he recently moved from Colorado to Miami, Florida. So that's the crew. And now let's talk. Let's talk about LP stuff that matters to LPs. Let's start with Pascal because I'm curious about that question. On LinkedIn, it says, "Hey, I built a $150,000 cash flow portfolio with 20 plus LP investments. Are you still making $150,000?"
Yeah, it's very interesting trying to figure out how do you promote yourself online. And originally it was higher, and it's still at 150. I had invested in the ATM portfolio, the Prestige ATM fund, and that
Two.
distributed $25,000 last year, and this year, that's been significantly less. And so, yeah, that piece has been a big drain on my portfolio. But yeah, generally, they're all performing pretty well. I have one fund as well, the cannabis. I'm in the Polaris fund, where it's a cannabis mortgage REIT. and they've had a couple non-performing loans in their portfolio that has dropped their usual, what they've made every year for the last 5 years. They like 12% annually, and that's dropped down to 6, and I'm unable to pull my money out. That's been gated. So I've had a couple of those experiences, but yeah, the whole plan was to build a diversified portfolio that could ultimately support my mom in her retirement.
Okay. Um, I'd like to talk about, uh, you mentioned generally they're generally performing well. Um, I have a follow-up question, then I'd like to move on. What what are the categories of stuff that you currently have invested in? Because from my portfolio as an LP, they are generally not performing well. One because because I invested in multifamily, and the largely multifamily distributions are on pause. So tell me what you invested in. Would love to hear that.
Yeah, cool. So I have like what I call like a LP investment schedule, just like a real estate investment schedule that has everything numbered. It's everything from uh self-storage. I'm in a multifamily fund with Grant Cardone. I'm in a couple individual multifamily projects. I'm in a retail. I'm in a development. I'm in an oil and gas fund. I'm in, multiple funds from DLP Capital. Um, and I also provide transactional funding to a wholesaler. And so a lot of those, I would say the two that I mentioned are the ones that have some hair on them, I guess I would say. But I've been primarily invested with people where I have liquidity and I can pull the money out. So more on the debt side of the equation. So let's say like 40% of my portfolio is in equity-based projects, and then the others in credit. And so I now have liquidity to deploy in this market. Yeah.
Interesting. Yeah, so the debt versus credit dynamic as an LP. Um, Nimesh, have you come across any challenges recently as an LP?
Yeah, of course. I mean, I definitely have a heavy emphasis on in multifamily as well. I think a lot of the projects that we're part of followed a certain kind of business model that involved debt being or following a certain pattern or expected pattern, and that obviously has changed things a lot for pretty much everyone in the space. So exactly to your point, I mean, most of my multifamily projects are have distributions on pause as well, and all the energy is being focused on preservation of the capital and the project itself, right? Um, I've been in some other kinds of LP positions where I've done some Bitcoin mining as well in terms of the kind of the infrastructure of that, which um, has kind of hit some snags there as well. So, while you try to do a lot of work and pay a lot of attention to different spaces and try to make a best calculated decision based on information available, there's definitely some bumps on the road despite all that.
Sounds like I'm in your Bitcoin mining thing too as
Yeah.
an LP. Yeah, yeah. Yeah, there's certainly a lot of bumps and snags and AKA alleged fraud that is being sussed out.
Right.
So what have you learned from what hasn't gone well so far? How do you take that in, what are you taking? What information are you taking and how are you applying that to now?
Yeah, it's the longer you spend in this space as a limited partner, limited investor, and you think you understand all the variables, it's really amazing how any one of those categories of variables can go awry, right? So the obvious thing everyone talks about is interest rates. That's the easy kind of topic to talk about. But every layer, like what happens if your property manager doesn't perform? What happens if the project is construction heavy, where it's a big lift in terms of renovations? Insurance. I mean, all pretty much every line item that sometimes I glossed over on many of the projects early on that to your question now, what do I pay attention now is really nothing it's not rocket science. It's not earth shattering. It is really pay attention to every single line item and understanding, okay, this sounds great. I trust the sponsor. They're making their best guess in terms of assumptions, but what if A, B, or C happens? Like I probably spend a lot more time trying to dig into that and learn more, which just makes me more of a savvy investor from that perspective.
How can you pay attention more to every line item and still maintain your sanity and still effectively like analyze multiple opportunities?
So, I mean, there's patterns, right? Like there's different opportunities, but then you can almost I actually leverage one against the other. So why is, let's say, sponsor A able to make this assumption for, let's say, insurance, and sponsor B says, "Oh, I'm not worried about insurance. It's going to stay flat, or maybe you grow by 3%, or whatever the number is." So if anything, it helps me ask better questions. So maybe I'm not paying attention to 33 items, or whatever the number is, but at least the big ticket aspects of any project are obviously really important. And then it's more than just asking the question to the sponsor. It's actually having some substance behind the question and almost anticipating the answers. And then
Mhm.
if I'm surprised with the answer, then having a follow-up kind of deep dive maybe on the other front.
Can you give an example of something that when you see a deal, you compare it with another sponsor's deal, and like an example of a line item that might be significantly off from one to another, one
Yeah,
sponsor to another?
for sure. I mean, I kind of mentioned as an example, but insurance has been a big red flag. I mean, insurance has gone up across pretty much in every market I've heard of that I'm at least I'm part of. So if someone's putting a project together that let's say we're invested 2 or 3 deals in a certain submarket, and there's a new project coming online, and I already know what the assumptions are, what the environment looks like over the next couple of years, and that sponsor actually is not in line with their assumptions. It's going to make me ask very pointed questions to the new project I'm assessing, right? Like if so, well, how are you able to attain maybe this kind of expense profile, since we're just talking about insurance, over the next 3 years? But then I know in my other project that's actually one of the big pain points where we're having to
Mhm.
navigate that and cut whole distributions in anticipation to be able to handle the bumps in insurance. So, from that perspective, while it's probably hard to overlap every single line item that we're referencing, but at least the big things that put projects at risk, interest rate, debt, performance of property management companies who you've used, if we pivot to that a little bit, if I know we've used a PM in another project in a certain region, and now this new project I'm looking at is using the same PM and they grossly underperform, that's going to be a big red flag for me, obviously. And I'll have to, it's going to be a lot of trust to put into the sponsor to understand why they're choosing them, and the fact that I'm going to feel comfortable moving forward in that specific project.
Nimesh, when you come across those types of deals where you see that the insurance is grossly miscalculated or underestimated,
Sure.
do you just write off the sponsor in cases like that?
It's a good question, right? Can sponsors
I
make
would.
mistakes? Absolutely.
I
Yeah,
I
I
think
mean,
I probably would.
and I guess the question is like, are they being logical, rational about that decision or how they've analyzed it? I'd love to hear it, but if it doesn't make sense with everyone else I've talked to, then yeah, they're gonna drop down those ranks quite a bit. Again, but then if it was just an error in judgment or kind of rationale, it makes me concerned that, okay, where else was that error made? What other big aspects of this project or underwriting was that mistake made? But it definitely raises a red flag, right? So everyone we're here all for a reason, right? I mean, we're on this panel talking about our mistakes we made as an LP. Sponsors, GPs make mistakes as well. But let's grow and learn from it, and it better not happen twice, right?
Trevor, I want to pivot to you for a bit. As I mentioned when I introduced you, you have a unique perspective in that you coach GPs and LPs, and you are also a GP but primarily an LP. And So you'll be able to come at it from a perspective of what you've learned personally, but also what you're hearing, the word on the street. So what are some things that you're hearing from LPs right now?
Well, thank you, Joe. And it's just such a wide range of things, as you said, on the GP side, on the LP side. And again, similar to our friends here, I'm fairly diversified. So myself personally, being in multifamily, self-storage, land, retreat centers, tech funds, crypto funds, all of those things, the majority of it is, multifamily, real estate. But on the other side of that, a lot of my clients that I coach, whether they're GPs or LPs, have a list that goes far beyond that. So when I talk about the word range, I always start off by saying that number one, not all markets are created equal, not all asset classes are created equal, and certainly different people are at different stages of their investment career. So the LPs that are new to real estate, or maybe they're intermediates, or maybe they're even experts, have a certain series of challenges, just like the investor that's a new LP. Maybe they're newbie, an intermediate, or an expert. That's why I say we can't tar the entire nation with the same brush. But if there is one, elephant in the room, and what's, compounded, I think more than anything, the LPs are really, really, operating under a different, understanding that it's these distributions that are really challenging on both sides, right? Because if we go back to 2017, 2018, 2019, 2020, even say 2021 pre-pandemic, you could throw a dart and, make money in real estate, where that kind of changed, and more so over the last year and a half, to where a lot of the people that are afraid to pause distributions, and a lot of the LPs that, just don't want to hear that their distributions have paused, have had to, obviously go down that path. So number one is really those distributions that are paused. Number two is, some of the sponsors going a little bit quiet or silent, people doing the freak out, wondering if their capital is safe. I mean, there's many different things we could open up here, but those are the ones I'd start to speak to.
If you're speaking to a LP client and he or she says, "Well, I don't know what's going on with the investment. Yeah, I'm not sure. I haven't." You said that some GPs are going silent, not communicating. What do you say to that LP with your client?
Absolutely. Well, again, we know that the foundation of every investment is you're only as good as you communicate, to your tribe. And that's something you've done very, very well, obviously, as I've had a front row seat to that for the last, 13 years, 14 years. But there are some people that are afraid to reach out. They don't know they know enough, or they haven't really gone into the deal, understanding, say, how the deal works, or all of the line items, or what the risk is. They've literally done what I started to do in transparency early, and that is bet on the jockey, not the horse. Right. So even if I go back to my early investment days, I bet on the sponsor. I bet on people like you, or Dr. Vikram Raya, or, with Viking, or even Dan Hanford with Passive, Good Egg with Annie and Julie. There's so many different people that we could throw out there, but it was really because I bet on them, because they had mentors and coaches and a track record, to where I think some of the LPs today have not done their due diligence. They don't feel confident reaching out to somebody, let alone saying, what's been the prime reason you've suspended distributions, or why aren't you running your business plan as you set out to in the early stages? So there's a little bit of doubt. There's a little bit of fear, Joe. There's a little bit of uncertainty. But I also say to my clients that, what? Adversity brings with it the seed of opportunity. And that's that great quote from Think and Grow Rich, where sometimes when things go upside down, it's an opportunity to learn. It's an opportunity to grow. And so I challenge them to pick up the phone. I challenge them to send an email. I challenge them to talk to other investors that might be in the deal, because information is power, but it's only powerful if you take action on it. And a lot of people are just a little bit reluctant to do it by feeling that they don't know enough about it, or they're afraid to poke the bear.
This is for anyone and everyone who'd like to answer. What aspect of the deal is overrated when reviewing it as an LP?
I think I would chime in here. I think it's easy to go into a deal and look at the numbers and get excited about the deal without looking at the sponsor. And it feels cliche to say it over and over, but it's I very much subscribe to the jockey, not the horse methodology. And you know, if looking at the deal, like the first thing I do after I look at a deal is I want to know what does their track record look like. And you can say it until you're blue in the face, but to me it's like a simple spreadsheet that shows the date they purchased a property, what they bought it for, you know, and like just having a simple list that's like all I'm looking for and need. And I think um nothing happens. My due diligence, when I look at a deal, I might look at the numbers. Oh, this is generally interesting to me. Let me go see what they've done is the first thing I do. And so to me, it's overrated the deal because people just really like to sink into that. Whereas that doesn't even really matter to me before I've done so much diligence on the sponsor.
One thing I'll add to that is on track record. It's should be not only what was purchased and what the return was, because that is just the bought and sold deals. It should also be of the current portfolio, what percent of the equity has been returned to date. Because like, my company, we have distributions that are paused on deals. And so it's important to show that on some deals we have had paused distributions and show the whole track record, versus just showing the deals that were all exited 2 years ago
Totally,
and now
totally
and now
agree.
now you're holding on. So when you look at a track record, make sure you're also seeking out their entire portfolio, current deals included, and what percent of the equity has been returned to date.
Yeah, I'll jump in on that as well. Very well said. And, I think for a lot of people, they think that, their market is the shining bright light in the sky, right? Where people in Texas love their Texas deals and they negate, perhaps what's going on in Florida or the Carolinas or Tennessee or Indiana. So I think sometimes when I look at, say a new deal or a sponsor, I want to know how well versed are they in that market, and are they just going to a market to invest out of state, but they're not really operating from there? Or is this just another shiny object syndrome? Because the deals that I can now look back on, and we all agree, gentlemen, that hindsight is 2020, where I've got people that are boots on the ground, taking care of the asset, making it sing, walking the property, doing, all the things that we all know are part and parcel of running that asset. It does make a difference. So not only how many deals have they done, but how well versed in that market are they is a huge, huge thing that I'm looking at now versus maybe, how I invested 5, 6, 7, 8, 10 years ago.
Yeah, Joe, I kind of add to what you said about the track record and understanding what projects are on pause in terms of distributions. One thing I think this carries over the question we talked about a little bit earlier in terms of what do I do a little bit differently now than before is when I'm looking at a sponsor, maybe one that I'm not familiar with, I do want to know what deals are paused and understand why. Being an LP of several projects that have paused distributions, each has its own unique reason and nuance. And I think understanding that from a sponsor is really critical, because if it's a pattern of the exact same miscalculation, going back to kind of the underwriting and the stress analysis process, if they're making the same mistake over and over, that's a concern. But if it's, if it's market specific, is it the debt structure? Is it, some performance, some other key KPI? It's just good to understand that and just help from your perspective.
How long ago was the last LP investment each of you did, and what was it?
Yeah, mine was a year ago. Again, I did not invest in any active deal in multifamily, at least since last year, and that was in Louisville, Kentucky.
It was multifamily about a year
It
ago.
was multifamily, you betcha.
Got it. I think I'm in that one.
You are.
Yep. As an LP.
Yes.
Nimesh?
I did a project just this past month. It was in the Atlanta submarket. It's definitely, this project was different than historically all the ones I've been part of. All the ones historically that I've done were value add, and you find a project that's in a maybe a good geographic location, just needs some attention or kind of renovations, things like that. This project was unique that it's a brand new build. It's only a year old or a year or two old, and really we're basically buying it without much value add to be done. However, because of how we're picking up the asset, there's a lot of equity that we're walking into based on the debt cycle and the interest rate situation. So it's definitely a different kind of business plan in terms of what I'm used to. But again, when you throw in the variables that we have in front of us, then we have to work around that, and it made sense.
So it's just buying at a higher cap rate now, and grow NOI, and ideally cap rates compress since it's a new property, and in 5 years that's the value.
Right.
Okay. Pascal?
Yeah, mine was the Polaris fund, the cannabis debt fund, and I did that about a year ago, and I think it was one of the things where I learned I didn't pay close enough attention to the loan tape, and I didn't realize. I should have made another check of the loan tape before I invested, because that loan tape that came out the day I wired my money was showed that the fund had, several non-performing loans that kind of came out of nowhere that, weren't uncovered or talked about in the diligence process. And so, yeah, that was a stumper.
You sent your money that day. Did you see it that day? And if so, couldn't you, if that was something that was a
I didn't see it that
showstopper?
day.
Ah,
I
okay.
didn't see it that day. I think these are all the tidbits that you learn as you invest, right? Like,
So that's why we're having this conversation. Yep.
it's like, knowing, when I'm investing in a private debt fund, like understanding the performance of where all the loans are in the portfolio, and is there an uptick or a downtick, and how is that being handled, and what do you see as the forecast? I think are now things I pay way more attention to,
Mm-hmm. What are some things in the PPM? Jay asked the question. I haven't been seeing everyone's questions, but I saw Jay uh as question flash before my screen, and I liked it. What are some things in the PPM that you all look at, and just a couple things that you always make sure you take a look at, or assuming that you look at the PPM and be honest. I'd like to hear everyone's thoughts. We're
I'll
looking
start.
at you now. Okay, yeah, Nimesh. Yeah, what do you got?
Yeah, I think one of the things I look at is really understanding the waterfall, right? A lot of times it's explained in the investment deck or maybe the emails that are sent out on deals, but understanding, like, when does the GP get paid? How does a deal have to perform before those who put all the time and energy and work into it get to recoup some of the revenues aspect of it? And at the end of the day, if let's say if the GP is going to be getting their cash for their revenue for running the project, regardless of how it performs, that's a huge red flag.
So
Waterfalls in
specific.
terms of
So like specifically, can you get specific there? Like what could be in there where it would be no, but you've seen it in there. It's like no, that's not how it should be.
let's say if the GPs are getting paid a certain amount of the revenue before or as part of maybe all the expenses that are paid out, at the bottom line, if that's taken out on the top end, and then at the bottom of all the calculations, whatever's left over is what's available to distribute for cash on cash to the LPs, I think that's a problem, because at that point we're no longer aligned in terms of the GP and LP roles, which is typically the kinds of projects you want to be a part of, right? If we're truly, I think, if I'm in an LP position, the GPs at the end of the project should get the bulk of the proceeds and equity gain and value that's been achieved if it's performed, and it's all been kind of reached hand in hand by percentage, of LP and GP positions.
Yeah,
I'd say
I look at,
go for
sorry,
it.
Pascal. I really think of things in terms of the 80-20 rule, because 80% of the PPM is great, but it's really that 20%. And for me, I don't get into the waterfalls as much as maybe some other people do. I really look at the nuts and bolts of the deal, where it is, what we're doing, what the business plan is, what the multiples are, what the IRR is, and really the interest rate. But it's really all about, is it pie in the sky, or is it, so far fetched that it doesn't even make sense? Because Joe, you know this about me. I've always lived by the phrase success leaves clues, right? Success leaves clues. And I'm not looking to hit home runs with my deals. I'm looking to hit, doubles. If we can hit a triple, that's great. Sometimes you're going to get a life lesson and hit a single, but consistency is key for me. So I'm really looking at comps. I'm really looking at, all of the things that really are very simple before I get too far into the weeds. But then again, I have the luxury of, working with and investing in a ton of people that I get to know pretty well, like yourself and Ashcroft Capital, where it becomes a no-brainer. But that's what I look at.
Yeah, I would say that I'm not the person that can go through a PPM and pull out a clause and say this doesn't sound right. But what I do is, after you've seen a bunch of these, you do know the general format and like what's included. Like, usually all the fees are outlined in a certain area and like what happens when things go sideways. And I'm usually trying to compare that to what I see in the marketing material. I don't think I'm sophisticated enough to go through a PPM and really, I mean, like pick apart things that don't make sense, right? Because but what I can do is make sure that what I understand about the deal is roughly what I'm seeing inside the PPM. So that's when I'm looking at a PPM, that's usually what I'm checking for.
All very helpful. What's something that we haven't talked about that you all think, man, why didn't Joe bring this up yet?
Yeah, I'll throw out the elephant in the room, the second one, which are cash calls. It's not only that distributions are being paused, but now, LPs have to pony up a little bit of money. And, there's people that understand the who, what, where, when, why of that. And there's people that are absolutely against it. So I would table that to just kind of bounce off of you guys and get the lay of the land with, anyone that's navigating or going through that landscape right now.
I don't know. It's been fascinating being a part of this ATM debacle, the Prestige Investment Fund, and I helped organize a WhatsApp group so that all the investors could go in and we could talk together and kind of like band together and kind of understand what's happening, because we felt like we didn't, we weren't getting the answers we wanted from the syndicators that put the deals together. And it was do I think there's fraud involved? Like, yes. Do I think there's, things that are going sideways? But what I think is not talked about often enough is we're still investing, right? Like deals go sideways when you invest, whether you're investing in the stock market or you're investing in a syndication. And like there are lots of factors at play, like, we talked about them, interest rates and property insurance and taxes and all those, things going up. But yeah, I think I've just had more of an appreciation that, things go sideways. And, I'm all for, putting pitchforks in the GPs that, sit silent and don't communicate. But, I do think there is just some humility, like, deals will go sideways and that's part of the process. And so I would just like to encourage, that being an okay, normal thing that happens in your investing career.
Nimesh, anything to add there?
Yeah, the thing I would add, I feel Pascal's in terms of what he's saying, and it goes back to, you can be an LP in a lot of different projects and diversify, but really understanding it, I just kind of really want to harp on that because, the ATM example, that fund where there's these these variables, this uncertainties. Well, why exactly is this happening? And it does take a group of people to band together to understand and share ideas and thoughts and information, and then you can understand it on the back end. But that's information we want to know on the front end, right? To be really comfortable with it. I I have my own set of LP positions that I also don't quite understand 100% of why it's not performing the way it is, or why things are paused, and the debt mining fund we chatted about and where things went awry. But at least for me on the multifamily side, that is one area I do understand well and better. And it didn't start that way. I mean, it's occurred over years and years of being part of projects and spending the time to want to learn more. And I only speak for myself, it's probably reinforced the idea that I'm going to spend less time chasing the shiny new object, in Coach Trevor's words. And while those opportunities are there, you hear people doing well on it, but it does take you really got to spend the time and energy to understand it. And that way, if it doesn't perform, at the end of the day, you're investing, there's a risk to it, and you understand why.
This question is for Pascal and Trevor, because Nimesh, when I asked the question, when was the last LP deal that you all invested in? You said about a month ago, correct, Nimesh? Yeah.
Correct.
So your answer to this question is yes, I know that. But I want to ask Pascal and Trevor this question. Is now a good time to put money in new deals as an LP?
I think there's always a good time. I think, if one market is up, one market is down. Well, if there's, office, if you have a long-term outlook, could be an incredible asset class. When things, it's like you want to do the opposite of what everyone's doing. Like everyone right now is shrinking up, not like they're scared to deploy, scared to put money in. And okay, I haven't put money into an LP syndication, but that doesn't mean I haven't made investments, in the stock market. And I think it's all a matter of like what opportunities come across your desk and like where is the pain. And if you have a long-term outlook, I try to look and run towards where there's pain, because that's where you're going to get the deep discounts. You're going to yeah.
Yeah, I'll stack on what Pascal said there, Joe. And you know this about me is, I look to add value, whether that's as a coach or an investor, as a husband, as a parent, a speaker, whatever it is. And there's a lot of great opportunities out there where I can add value. And so I think if we look at the timeline of where I haven't, say, invested in multifamily, again, I'm investing in other things. I'm investing in disruption. I'm investing in some angel opportunities that have come our way. I'm investing in crypto, right? I do believe that, when we really look at where the puck is and where the puck is going, I mean, the greatest thing that I'll say is real estate has absolutely changed my life, and it's changed yours. And it's one of the greatest ways to make money in America. I don't think that's going away, but I also believe that, I'm at a different place today in my horizon as an investor than I would have been 10, 15 years ago. And so while I'll continue to invest in real estate, predominantly multifamily, maybe a little bit of self-storage, maybe some land development, some ground up, we'll take a look at that. I'm also looking to, again, look how AI is coming in, blockchain is coming in. My clients are doing some phenomenal stuff in that arena, and it's new. It's not for everyone. It's not for the faint of heart. It's a little bit of the wild, wild west. But again, I go back to the fact that we all have range, and where some people like to stay in their lane, AKA, somebody that I know very well that might be on this call and has done extremely well with multifamily. I've got other clients that will do everything from multifamily to, self-storage, to pickleball centers, to car washes, and everything under the sun. And that's where I caution, different people to really think, who are you and what is your tolerance? Because again, you can go spread your money all over the place, or you can tend to stay in a lane that I like to stay in a lane I know, but I also like to dabble just outside of that. And I always think of it as maybe a 3 or a 4 lane highway or interstate. I know the lane I'm in, but I'm not afraid to go and invest in this lane or this lane, because I'm going to learn something. And sometimes when I go out there and I invest in another asset class, I do it to make money. There's no question about it. I love money and money loves me, but I know that I'm going to learn something that I can then cross pollinate and bring back to some other things that I'm investing in. And for me, Again, I've had some money lessons, and I've been hit over the head a few times with a 2x4, but I'll bet everyone that's listening to this call, whether you're on live or doing the replay, has also really realized that there is no failure. There's only feedback. And as limited partners, we're always going to get feedback, and we're going to be able to then take it and climb the next mountain with it. What do you think?
I love it. And thank you for that. And thank you all three of you for participating in this panel. We have some questions. We have just a handful of minutes left. So I'm gonna just quickly address, if we can have really quick answers on these. Any of you invest in mortgage notes? This is from
I do.
Marty. You do? Okay, so yes, Marty. Pascal does. Anyone
DLP
else?
lending fund, preferred credit fund. Yeah.
Cool. Okay. When evaluating them, what's something that you should pay attention to, Pascal?
Loan tape.
Loan tape. There we go.
And distributions. Like if these companies should be making distributions monthly. Like you can easily go look how many. Yeah.
Okay, got it. Let's see. And Mickey asks, would you invest in a fund if a sponsor did not put their own money? If they do invest, what percent of their own money do you think they should put into the investment? Actually, Chris on our chat had I thought, a really good answer. Mickey, I won't invest more than the GP invests in the deal. Anyone else want to add to that? Or are we good with that one?
That's a great rule.
Yeah, nice work,
Yeah.
Chris. Thank you for help.
Great.
We've got another. How do you analyze the GP fee structures in the PPM, and where do you see the fee? Where do you all see fee percentage typical in the current environment? I can probably take that one. The waterfall split should be much more in your favor than it has been in the past. I can tell you what we've been doing is the more you invest, the better percentage. And if you invest over a certain threshold, you get 100%. Whereas before it was always, or not always, but I believe mostly it was like a 70-30 split. But now I see groups, ours included, doing 90-10, 80-20, 70-30, but rarely 70-30. It just depends on what you invest. So it should be much more favorable waterfall structure now when you look at a deal, because it's harder to raise money right now. And so you have more leverage there. As far as fee structure, acquisition fees anywhere from 1.5% to 3%, I'd say, and asset management 2% or so. I think those are the main ones that I've seen. Let's see. I think that's. I mean, there might be some miscellaneous ones that we didn't get to answer, but I don't think we can get to everyone's. But I think we covered a lot. So thank you, everyone. We've got. I want to mention each of your websites one more time. So Nimesh, you can go check out his company, lionparkcap.com, LIONPARKCAP.com. Trevor McGregor, well, his name's right there in front of his face. So trevormcgregor.com. That's nice and easy to go look at what Trevor has going on from a coaching, a consulting standpoint to help you get to the next level. And Pascal, growyourcashflow.io. Growyourcashflow.io. So with that, I want to mention to everyone that Best Ever Conference is coming up. We sold out our early bird tickets for the first time ever, and we are allowing the purchase of the next round of tickets later this week. Here is a beautiful QR code that the team put together, and you'll get first access to these within the next. If you buy them within the next 48 hours, you'll get access to it. But we are opening up a limited amount later this week. But right now, you can go get it. It'll be the best price that you'll get. If you miss out on it, then the next round to get a ticket will be a higher price. So here's your. Let's see if this little thing's in the way. Yep, here we go. So here is your coupon code BEC Webinar 10. You'll get an email right after this. Put in, get the discount, and Everyone on this call been to the Best Ever Conference? I know 2 out of 3. Nimesh, you been to the Best Ever Conference?
I've been 4 times. Yeah, it's been
You've
great.
been 4 times. All right. Well, shame on me. Sorry about that. So, anyone want to talk smack about the Best Ever Conference, or do you all just enjoy it so much that, well, one of you's been 4 times? Trevor, you've been like every year or so.
I've been there. I've been there since day one, Joe, and I've been
Yeah.
blessed to obviously, speak from stage, be a sponsor every year, other than the pandemic. But I truly, out of all the conferences that clients ask, which one should I go to? Which one should I go to? Hands down, the best ever is named the best ever for a reason. If you've been,
Yep.
please come back in March. And if you haven't, for goodness sake, sign up, grab that QR code now, as you'll absolutely understand this is all about, what people think it's about competition, but it's really about collaboration. And that conference is just the best that you can get for that.
Yeah, you get to meet a lot of different people.
It's kept
Experience.
me in real estate the whole time. I mean, it's re-energizing. You learn a ton, you meet great people, and I'm with Coach T. I only go to one real estate conference a year, and this is it.
You'll find experienced commercial real estate investors who are humble and want to be helpful. That is this conference, and the gentlemen on this virtual stage with me, they embody that. So thank you, everyone. Enjoyed it. Let's go. Go watch something on Netflix or go have dinner or whatever you need to do now. But enjoyed this evening. Enjoyed the time, and I'm confident that the LPs on this call got a lot of value from it. I know I did. Thanks, everyone.
Thanks, Joe.
Sounds good. Thanks, Joe.